Hey everyone, Iggy here from the Investing Iguana. Today, we're diving into the shocking collapse of one of Southeast Asia's biggest textile manufacturers, Sritex. This isn't just another business failure story. What we're witnessing is the canary in the coal mine for Indonesia's entire manufacturing sector. Most people think major industrial collapses happen randomly or just due to poor management. But when we look deeper, Sritex's downfall reveals a systematic pattern of deindustrialization that's threatening Indonesia's economic future. I've analyzed the data, and the patterns are clear. This collapse is part of a much bigger economic story. In the next 25 minutes, I'll break down how a small fabric shop grew into a textile empire, why it suddenly collapsed, and what this means for Indonesia's economy, and possibly your investments in emerging markets. Let's get started. Imagine starting with just a small fabric shop and building it into a company that outfits NATO forces. That's exactly what happened with Sritex. Back in 1966, Muhammad Lukminto opened a modest shop in Solo, Central Java. Within just 2 years, he expanded into textile production, and by 1978, Sritex had become a limited liability company. What made Sritex special was its vertical integration model. Unlike many competitors who specialized in just one part of the production chain, Sritex controlled everything from raw materials to finished products. This gave them a significant competitive advantage in the market. The company's big break came when they secured contracts to produce uniforms for the Indonesian armed forces, but they didn't stop there. They expanded internationally, winning contracts with the German military and NATO. At the same time, they became a major supplier for global retail giants like Walmart, Sears, H&M, Uniqlo, and Zara. By 2019, Sritex had reached its peak with annual sales of $1.3 billion. That's 21.1 trillion rupiah. They had transformed from a small local business into one of Southeast Asia's textile manufacturing powerhouses. The company employed around 50,000 workers across its group, making it not just an economic success story, but also a vital source of employment for tens of thousands of Indonesians. The success of Sritex wasn't just luck or good timing, it represented a carefully executed business strategy that aligned perfectly with Indonesia's economic development model in the late 20th century. Indonesia, like many developing countries, saw manufacturing as the pathway to economic growth and prosperity. The government supported the growth of manufacturing through various policies, including tariff protection, subsidized credit, and infrastructure development. Sritex took full advantage of these policies while also building its own competitive advantages. The company invested heavily in modern machinery and production techniques. They also developed strong relationships with both government and international clients, positioning themselves as a reliable supplier in a region often perceived as having unstable business environments. The company's founder, Muhammad Lukminto, was known for his business acumen and ability to navigate Indonesia's complex political and economic landscape. After his passing in 2017, his son Iwan Lukminto took over as CEO, continuing the family's leadership of the company. Under Iwan's leadership, Sritex continued to expand, even as warning signs began to appear in the global textile industry. But as we're about to see, even giants can fall, and when they do, they create shockwaves throughout the entire economy. The beginning of the end for Sritex can be traced back to 2020. When COVID-19 hit, it disrupted global supply chains and crushed consumer demand worldwide. For a company that relied heavily on international contracts, this was devastating. Sales plummeted from $1.3 billion to $847 million. That's a drop of more than 35% in a single year. But here's where things get interesting, and where we can learn our first major lesson about economic collapses. Instead of scaling back operations to match the new reality, Sritex continued to take on more debt. By mid-2024, their total obligations had ballooned to $1.6 billion, nearly double their 2019 debt level. This is a classic case of what economists call debt overhang, when a company takes on so much debt that it becomes impossible to invest in new opportunities because all incoming cash goes to servicing existing debt. It's like trying to run a race with increasingly heavy weights strapped to your ankles. In 2022, Sritex managed to reach a temporary debt restructuring deal with creditors, But it was too little, too late. Creditor confidence had already been shattered. By October 2024, one of their creditors, PT Indo-Bharat Rayon, had had enough and filed for Sritex's bankruptcy, arguing the company had failed to meet its debt obligations. The court ruled in favor of the creditor, and Indonesia's Supreme Court upheld this decision in December 2024, making the bankruptcy legally binding. On March 1st, 2025, just a week ago, the Sritex factory floors fell silent as the company officially ceased operations. Looking more closely at the debt situation reveals a troubling pattern that's common in many corporate collapses. Sritex had issued dollar-denominated bonds worth hundreds of millions of dollars. This strategy made sense when interest rates were low and the Indonesian rupiah was stable. But as global interest rates rose and the rupiah weakened against the dollar, servicing this foreign currency debt became increasingly expensive. This highlights a critical vulnerability that many companies in emerging markets face: the original sin of borrowing in foreign currencies. When local currencies depreciate, the real cost of this debt can skyrocket overnight. For Sritex, this currency mismatch became a significant factor in their inability to meet debt obligations. Another factor that contributed to Sritex's collapse was the changing nature of global textile supply chains. Fast fashion retailers, which made up a significant portion of Sritex's customer base, were increasingly demanding shorter lead times, more flexibility, and lower prices. At the same time, competition from countries with even lower labor costs, such as Bangladesh and Ethiopia, was intensifying. Sritex found itself caught in a squeeze, rising costs on one side and downward pressure on prices on the other. The company tried to adapt by investing in automation and more efficient production methods, but these investments required capital, which meant taking on even more debt. The COVID-19 pandemic was the final blow that pushed Sritex over the edge. Not only did it cause an immediate drop in orders, but it also accelerated changes in consumer behavior and retail patterns that were already underway. Online shopping increased, physical retail declined, and consumers became more conscious about sustainability and ethical production, all trends that disrupted traditional textile manufacturing business models. But here's what makes this story more than just a business failure. Sritex wasn't struggling alone. They were part of a much larger pattern affecting Indonesia's entire textile industry. Before we dive deeper into the economic implications, we need to acknowledge the human side of this collapse. In just the first 2 months of 2025, at least 10,665 employees lost their jobs across Sritex Group's 4 factories in central Java. Many of these workers had spent their entire careers at Sritex. The timing of the shutdown has raised serious concerns among labor unions. It occurred as the Ramadan fasting month began in Indonesia, leading many workers to suspect this was a deliberate strategy to avoid paying Eid al-Fitr bonuses. During a parliamentary hearing, Slamet Kaswanto, head of the Sritex Workers Union, voiced these concerns directly. We're asking, is this a way to deny us our rightful bonuses? This highlights a critical aspect of economic collapses that often gets overlooked in financial analysis. The timing and manner of bankruptcies can sometimes be strategically planned to minimize cost to owners while maximizing the impact on workers. The Indonesian government has pledged to assist these affected workers. The Ministry of Manpower claims to be working to ensure that severance payments and unemployment benefits are dispersed. They've also stated they've identified 10,666 job vacancies in Surakarta and surrounding areas in industries including apparel, food and beverage manufacturing, and services. Additionally, the government is coordinating with the Curator team, which has opened up opportunities for former Sritex workers to potentially return to work at the same company if investors rent Sritex's production equipment. The Curator team is committed to fulfilling the rights of former employees, including severance pay, with a focus on dispersing the old age security and job loss security funds before Eid al-Fitr 2025. But even with these efforts, the sudden loss of over 10,000 jobs represents a significant shock to the local economy and the lives of thousands of families. The human impact goes beyond just the loss of income. Many of these workers had developed specialized skills that may not be easily transferable to other industries. The textile industry requires specific knowledge of materials, machinery, and production processes that might not be valued in other sectors. This means that even if workers find new jobs, they may have to accept lower wages or positions that don't utilize their expertise. Furthermore, the social impact of mass layoffs can be devastating for communities. When a major employer like Sritex collapses, it doesn't just affect the workers directly employed by the company. It also impacts local businesses that depended on those workers as customers, restaurants, shops, service providers, and more. The economic ripple effects can lead to a downward spiral in local economies, particularly in areas where Sritex was the dominant employer. There's also the psychological impact to consider. For many workers, especially those who had spent decades at Sritex, the company was more than just a source of income. It was a source of identity and purpose. The sudden loss of this can lead to depression, anxiety, and other mental health issues. Studies have shown that mass layoffs can even lead to increased rates of substance abuse, domestic violence, and suicide in affected communities. The gender dimension of these layoffs is also significant. The textile industry in Indonesia, as in many countries, employs a high percentage of women. For many of these women, employment at Sritex represented economic independence and empowerment. The loss of these jobs could potentially reverse progress in gender equality, particularly if alternative employment opportunities are limited or less accessible to women. When a company as large as Sritex faces bankruptcy, it's not just a business issue, it becomes a political one. President Prabowo Subianto's new administration recognized this and attempted to intervene. In late 2024, the government assigned 4 ministries, including the Ministry of Industry and the Ministry of Finance, to explore rescue options. Despite being a newly elected president who took office just last week in October 2024, Prabowo ordered his cabinet to find solutions for Sritex quickly. The government even granted Sritex permission to continue its export-import operations despite the bankruptcy ruling. Coordinating Minister for the Economy, Erlangga Hartarto, explained that this decision would allow Sritex to continue operations, safeguarding the jobs of its workers. However, there were limits to what the government was willing to do. A major labor group called for a state bailout to prevent massive layoffs, but the government made it clear there was no plan for such a bailout. As Dr. Pernomo, an expert quoted in the search results, pointed out, it's clear that Sritex's bankruptcy stems from a large amount of debt. They've bitten off more than they can chew. Instead of a bailout, the government's current strategy focuses on finding investors to rent Sritex's equipment to restart production and potentially reabsorb some of the laid-off workers. Minister of State Secretary Prasetyo Hadi stated that President Prabowo expressed his concern about how the government finds a solution, especially regarding potential problems that might occur to the workers at Sritex. So what does all this mean for investors and for Indonesia's economic future? Let me break it down. For investors in emerging markets, Sritex's collapse serves as a cautionary tale about the risks of investing in manufacturing companies in middle-income countries caught between low-cost producers and high-tech economies. It highlights the importance of looking beyond company financials to understand the broader competitive dynamics and government policies affecting an industry. For Indonesia specifically, the path forward requires addressing several key challenges. First, the government needs to develop a coherent industrial policy that addresses the competitive challenges facing its manufacturing sector. This might include targeted investments in infrastructure, workforce development, and technology adoption to help companies move up the value chain. Second, Indonesia needs to address the issue of cheap imports flooding its domestic market. This doesn't necessarily mean protectionism, but rather ensuring fair competition and preventing dumping of excess production from other countries. Third, the country needs to diversify its economy beyond traditional manufacturing while still maintaining a strong industrial base. This means investing in education, research and development, and digital infrastructure to foster innovation and entrepreneurship. The good news is that Indonesia has significant advantages: a large domestic market, abundant natural resources, and a strategic location in Southeast Asia. If it can leverage these advantages while addressing the challenges facing its manufacturing sector, it can still achieve its vision of becoming a high-income country by 2045. As we wrap up our analysis of Sritex's collapse, let's recap the key lessons we can learn from this case. First, debt can be a double-edged sword. While it can fuel growth during good times, excessive debt can quickly become unsustainable when market conditions change. Sritex's debt doubled between 2019 and 2024, ultimately leading to its downfall. Second, global competition in manufacturing is fierce and constantly evolving. Countries and companies that can't adapt to changing competitive dynamics risk being left behind. Indonesia is currently caught between low-cost producers like Vietnam and Bangladesh and more advanced economies. Third, government intervention has its limits. Despite efforts to save Sritex, the Indonesian government couldn't prevent its bankruptcy. This highlights the challenges governments face in supporting struggling industries in a globalized economy. Finally, industrial development remains crucial for economic growth in developing countries. Indonesia's declining manufacturing sector poses a serious challenge to its long-term development goals. Finding ways to revitalize manufacturing while also diversifying the economy will be essential for future prosperity. For those of you looking to apply these insights to your own investment strategies, I've put together a free guide on navigating emerging market investments in the age of deindustrialization. It includes a framework for assessing country and industry risks, along with specific metrics to watch. You can find the link in the description below. Thanks for joining me for this analysis. If you found it valuable, please hit the like button and subscribe for more economic insights. This is Iggy from the Investing Iguana, and I'll see you in the next video.